All right, today we're jumping into one of the most essential topics in accounting, inventory. We're going to break down the official rulebook, IAS 2, to figure out exactly how businesses put a value on all the stuff they plan to sell. Let's get right into it.
Really think about that for a second. You could be a tiny little bookstore or a giant car company. It doesn't matter. Every single business that holds physical products has to answer this question. How on earth do you put a dollar value on all that stock? And it's not just a nice-to-know number. It's absolutely fundamental to figuring out if you're actually making money. And the answer, for a huge part of the world, is found in a standard called International Accounting Standard 2, or just IAS 2 for short. Think of it as the official guide, the rulebook that makes sure companies everywhere are on the same page and speaking the same financial language when they talk about inventory. Now, this quote here is pulled straight from the standard itself, and it really gets to the heart of the matter. It might sound a little formal, but the idea is actually pretty simple. IAS 2 is all about deciding how much something costs you. That's your asset. And then, crucially, knowing exactly when to turn that cost into an expense after you sell it. It's all about making sure your costs line up perfectly with your sales.
Okay, so before we can start putting a price on it, we need to be crystal clear on what inventory even is. You're probably just picturing products sitting on a shelf ready to go, right? Well, IAS 2 is a little more specific than that. So according to paragraph 6, inventory actually comes in 3 different flavors. First, you have the obvious one, stuff that's held for sale, finished goods. Then you have things that are in the process of being made. And finally, you've got the raw materials and supplies that are just waiting to be used. Let's make that a bit more real. Let's imagine a simple bakery. All that flour, sugar, and those eggs sitting in the storeroom? Yep, that's inventory, specifically raw materials. The cake that's literally in the oven right now, halfway done, that's also inventory, what we call work in progress. And of course, that beautiful, fully decorated cake sitting in the shop window ready to be sold, that's a finished good. See? All 3 are part of the inventory picture.
Okay, we've nailed down what inventory is. Now for the really important bit. How do we calculate what it's all worth? Let's dig into what actually goes into that final cost number. IAS 2, in paragraph 10, gives us another handy 3-part list. The total cost of your inventory is made up of what you paid to buy it, what it costs you to convert it into a final product, and any other costs you had to pay just to get it to where it is, ready to be sold. So let's start with the cost of purchase. It's not just the price on the invoice. As you can see here, you also have to add in things like import taxes and shipping fees. But here's a key detail. You have to subtract any discounts you got from the supplier. So the real cost in this case isn't $1,000, it's actually $1,130. Next up, we have conversion costs. If we head back to our bakery, this is everything it takes to turn that flour and sugar into a delicious cake. It includes things like the baker's wages, that's what we call direct labor, and a fair share of the factory's running costs, like the electricity for the oven or the rent for the kitchen. We lump those together as production overheads. Now, this is just as important, what you can't include. Paragraph 16 is super clear on this. Let's say a baker accidentally drops a whole bag of flour on the floor. You can't add the cost of that wasted flour to your good inventory. Nope. And you also can't include the cost of storing finished cakes, paying the accountants in the main office, or running a marketing campaign. Those are just general business expenses. So we know what costs to include. But what if things change? What if your inventory suddenly becomes less valuable after you've already made it? This question brings us to what is, without a doubt, the single most important rule in all of IAS 2. And here it is, straight from paragraph 9. This, right here, is the golden rule. You have to value your inventory at whichever number is lower, the cost that you just calculated, or something called net realizable value. So what's the difference? Well, cost is all about the past. It's what you already paid to get the item. Net realizable value, or NRV, is all about the future. It's what you think you can sell it for, minus any extra costs you'll have to pay to get it sold, like packaging or a sales commission. You do the math for both, and you have to pick the smaller number. But why? Why go through all that trouble? Why not just stick with the price you paid for it? What's the thinking behind this super cautious approach? Paragraph 28 tells us exactly why. It's a rule of prudence. Basically, accounting standards don't want companies pretending their assets are worth more than they really are. If you've got a warehouse full of old phones that cost you $500 each, but you know you can only sell them for $300 today, It's just plain misleading to say they're still worth $500 on your books. This rule forces you to be realistic.
Okay, we're on the home stretch. Let's tackle our last major topic. Imagine you buy the exact same item multiple times, but the price keeps changing. When you sell one, which cost do you use? The old, cheaper price or the new, more expensive one? IAS 2 gives us two ways to handle this puzzle. Let's use a really simple example to see this in action. A phone shop buys 10 phone cases for $5 a pop. A few days later, prices have gone up, and they buy 10 more of the exact same case, but this time they pay $7 each. So now they have 20 identical cases that cost them a grand total of $120.
The two methods the standard allows are FIFO and weighted average. FIFO is short for first in, first out, and it's exactly what it sounds like. You assume you sell your oldest stuff first. Weighted average, on the other hand, kind of smooths everything out by calculating one single average cost for all the identical units you have. All right, now let's say the shop sells 12 of those cases. Under FIFO, we pretend they sold the first ones they bought. So that's all 10 of the $5 cases, and then 2 of the $7 cases. Add it up, and your total cost of sales is $64. That means the 8 cases left over are valued at that newer, higher price of $7.
Now what about the weighted average method? It's a bit different. First, we find the average cost. $120 divided by 20 cases gives us an average of $6 per case. So the cost for selling 12 cases is just 12 times $6, which is $72. Now look at that. The cost is $72 here, but it was only $64 under FIFO. This is so important. The accounting method a company picks can directly change its reported profit. So let's just quickly recap the absolute must-knows. First, the definition. Remember, inventory is more than just finished goods. It's also raw materials and work in progress. Second, measurement. This is the golden rule, always value it at the lower of cost and net realizable value. Third, that cost isn't just the purchase price, it includes all the necessary costs to get it ready for sale. And finally, the formulas. For identical items, a company has to pick either FIFO or weighted average and stick with it. And that brings us to one last thing to think about. This standard gives us a solid set of rules to follow. But remember that net realizable value calculation? That depends on a company estimating future selling prices. So while the rules are black and white, applying them in the real world means making educated guesses. It really makes you wonder how much of accounting is pure science and how much is a bit of an art. Something to chew on.